I'm going to be talking kind of about, I'm going to spend most of my time talking about capital transaction taxes, such as capital gains tax, capital acquisitions tax, the stamp duty, and specifically some of the issues around single payment entitlements and how they are transferred, because there's tax implications associated with those. I'm going to then look at a little bit on income and corporation tax issues, because it already came up this morning about farming companies, so I'm going to very briefly cover some of those. I suppose, where does Teagasc fit into this whole area of tax? Our business is not given tax advice. Our core business is technology transfer. We provide educational training and advisory services in agriculture. We don't give tax advice. We stay kind of well away from that. We leave that to the professionals that are keeping up on the latest knowledge in the whole tax area. But as advisors dealing with clients day to day, we regularly get consulted when farmers are taking on or thinking about transactions that have major tax implications. So we're regularly asked about our opinion in relation to selling a farm, buying a farm, where that would include just land or include land and entitlements. We'd be regularly consulted on farm succession issues. We've held succession seminars in the last year that attracted huge crowds where we give out a lot of information, and advisors would regularly act as a sounding board towards these kind of succession issues about bringing in family members and how to divide up farms fairly and so on. And the tax implications around that are obviously important. And as I say, while we don't give detailed tax advice, we would kind of point people in the general direction. Geez, you need to talk to your solicitor about that, or your accountant about that, before you go too far down the road of the transfer. And a particular area of interest, for my particular area of expertise, is in the financial planning and investment planning, and obviously there's tax implications around that. We refer all our clients, if there is particular tax implications, we say you need to talk to a tax advisor, you need to talk to your accountant, or if there's a legal issue, you need to talk to your solicitor. And we try and do that as early as possible in the process. If we become aware that a client is thinking of something along those lines, that we refer them early and make sure they get the proper advice. I suppose a lot of the changes that have happened in relation to primary agriculture policy and the tax policy that affects farmers on the ground, some of the changes that have happened in recent years are very much influenced by the Food Harvest 2020 report, which Jim Power kind of referred to this morning. There's very kind of ambitious targets in there, and a lot of the tax policy changes that have been brought on board by the Department of Finance, with the influence from the economic section in the Department of Agriculture, have been around trying to encourage people, farmers, to scale up and to get ready to produce the extra production that's required to meet those targets. So increasing the scale, a lot of the initiatives around the capital taxes in particular have tried to remove the disincentives and possibly even incentivize people to take on more land area and increase the scale of their farms. And also tying into what Ben has been going through, to try and encourage collaboration, because it's well recognised that no matter what incentive you put in to actually transfer the farm, there's a great draw for owning land in Ireland, and always will be, I think. And while taxes, is a factor in there in influencing farmers' decisions, I'd say a lot of it is still going to remain held in non-active farmers' hands. And trying to encourage more collaborative arrangements is key to getting the land into the hands of active farmers. So a lot of the tax policy changes have gone down the road of trying to influence those decisions. So just to get into the capital transaction taxes, and I mean, a lot of you in the audience here are well familiar with the way these operate and the various reliefs, and I'm only going to touch on some of the reliefs. And I suppose it's from the point of view of the kind of things that I have become aware of in just talking to advisors, or advisors would consult me on kind of the practicalities of some of these reliefs in particular farm cases. So I'm not going to deal with every single angle, but some of the angles, as I say, that I've come across might be of interest to you. I suppose in relation to these capital transaction taxes, and it kind of contradicts the slide that I was saying, that tax policy is trying to influence land moving and greater mobility, and then on the flip side of that, you have some of these particularly the tax rates and the reliefs seem to be disincentivizing it, because we've seen, if you take the 2 years 2008 to 2014, you can see that the tax rates in relation to capital gains tax, capital acquisitions tax, has increased by the guts of 65%. 30%, and some of the reliefs, the very useful reliefs that are there, have also been trimmed back by 50% as well. And we've also had kind of ceilings imposed on some of the valuable reliefs. I've seen it quoted in several documents, you know, that, and it was particularly in the Commission of Taxation report, you know, some of these reliefs were identified as being very attractive and very useful, but specifically targeted at agriculture. And that's a kind of a worrying thing, that, you know, that's down the road, that some of those could be targeted for further cuts or even amalgamated. And there's been a number of, you know, in the Commission of Taxation report, there was talk of amalgamating some of these reliefs, which would be, you know, detrimental to farm transfers. In relation to capital transaction taxes, as I say, we want people to take advice early, and particularly, you know, because these reliefs are so valuable, you know, one wrong move, either transferring too early or too late, could rule somebody out of availing of a very valuable relief. And once that job is done, it's very hard to reverse out of it. So maximising the benefits is, you know, when the relief is there, why not make use of it? And avoid potential clawbacks is another issue. You know, we don't want somebody doing something, if they availed of relief in the past, if they take on to do some other transaction that results in the clawback of their previous relief and they end up paying more tax. That'll be a mortal sin or a venial sin. I don't know which is worse than the other, but you know, there's something you want to avoid anyway. And it may involve, you know, by proper planning with your accountant and your solicitor. It may involve bringing forward or pushing back a date of transfer. It may involve postponing the transfer entirely, and, you know, and allowing assets to pass through will or whatever. It may involve kind of restructuring asset ownership to avail of certain reliefs, to pass various tests to allow you to avail of reliefs, and or it could be kind of meeting kind of various educational qualifications in order to allow young farmers to avail of some of the reliefs. In relation to retirement relief, and there's a couple of slides there on the basics of how retirement relief works, and I'm not going to go through them. You know, the age 55 kind of limit, the qualifying assets and so on. The thing that comes up time and time again when we do mention retirement relief to individual farmers, and they say, oh, Jesus, you know, I want to pass the land over, but I don't want to retire, you know, and that's something you have to say, well, you don't have to take to the corner. You don't have to kind of hang up the boots and you know, move indoors entirely. It's not retirement in the strict sense of the word. So, you know, farmers do need to kind of, they don't know the ins and outs of a lot of these reliefs, so you do need to go explain kind of the basics on how they operate. But I mean, in relation to retirement relief, the big change that's kicking in, you know, from the 1st of January this year, as you know, is, you know, there's ceilings being imposed on the relief depending on the age of the disponer. I mean, the 55 age limit is key. Until you cross that, you won't avail of the relief anyway. But between 55 and 66, the reliefs stay as they are currently, but as soon as you cross that 66 threshold, there's limits or additional ceilings being put on it. The 3 million ceiling that's being put on the transfer, say within the family or to a child of the owner, you know, it's going to affect some of the larger farms, maybe not, you know, the vast majority of farms in the country. The transfer to any person other than a child where the disponer crosses 66, that relief has been well pared back to, you know, to 500,000 from 750,000, and that could affect, you know, quite a few farms where there's you know, there's no family successor identified. In relation to that 750k limit, which is what's there at the minute if somebody is between 55 and 66, you know, a couple of cases have come to light, you know, across my desk in the last number of years where that's been exceeded by a particular farmer and has resulted in clawback of the relief, and that's something, you know, you want to avoid, and by proper planning, you know, is something that, you know, a good accountant or tax advisor could steer a person in the right direction. You know, if somebody has availed of the relief on a previous transaction and then decides to do another disposal, puts themselves over this limit, and then they end up being clawed back, their previous relief is clawed back, and that'll be a complete disaster altogether to happen. And what happens sometimes is disposals to spouse, as we know, are tax exempt, CGT exempt, but they do erode this particular limit, and that can catch some people out. So you know, a planning tool around kind of avoiding this is you know, making sure that the cancellation of the earlier relief doesn't happen, is that you make the asset that you plan on disposing of, you make it non-eligible for retirement relief, and that could mean, you know, renting it out for a short period of time making it a non-qualifying asset, you break that 10-year ownership and use rule, which is a kind of a main plank of the condition of the retirement relief. And once that happens, then the asset becomes non-eligible for retirement relief, so it doesn't push you over the 750 limit, and you can transfer it. You'll have to pay your capital gains tax, but you would have had to do that anyway because you were crossing the limit. So it's something that came up in one case that I was aware of. In relation to the whole availability of relief where land is leased out, you know, there was since 2007 there was a particular clause in there that allowed somebody to lease out land because, as I say, we do recognise that land leases have a very significant role in bringing land into the hands of active farmers. But then, if the farmer eventually wants to transfer that land, you know, he may kind of rule himself out of the retirement relief and end up paying capital gains tax, and that could be a disincentive. So a clause was introduced that if the disposal was to a child, you know, and the land had been leased out for no more than 15 years, that you'd still get relief, and that was a welcome at the time. But it's been relaxed even further in the last budget, and it's been opened out where retirement relief is now going to be available on all such land to any person, including a child, after the 1st of January, provided the land has been leased out for a minimum of 5 years, and that's a difference that's been brought in this time for this lease to any other person as opposed to the lease to the child. You could have short-term leases or con-acre type arrangements for shorter periods and still qualify for retirement relief, provided you didn't break the kind of the 15-year maximum limit of leasing. But for this particular case, if the eventual disposal is to a person that isn't a child, you have to have kind of minimum 5-year lease blocks in there in order to qualify for it. And you know, the long-standing condition of this 10-year ownership and use test, you have to have met that prior to the first leasing as well, and you'll still avail of the retirement relief. And that links in quite well with the land lease income relief that's available, that's been there for a number of years now, where somebody can lease out their land and get income tax relief on the lease payments. So they can avail of that relief and eventually then transfer it out if they don't have a child to transfer to, and still avail of retirement relief. So that's a useful, and as I say, that's part of one of those tax policies that's helping people you know, still kind of avail of tax reliefs to get shift land on and still avail of retirement relief at the finish up. A new relief that was brought in 2 years ago was the CGT Restructuring Relief. It's in Section 604B of the Tax Consolidation Act, and it allows relief from capital gains tax on the transfer of land where other land is purchased, and it's also available for land swaps. And it's to try and encourage consolidation of farm holdings by reducing the fragmentation. Big problem, I know it was referred to this morning, is the number of different parcels of land that farmers have. You know, I think there's an average of about 3.5 individual parcels on most farm holdings, and fragmentation is a problem. It's reduced efficiency. You have time travelling to and from parcels for herding and so on, and diesel usage and everything else. Plus it limits the farmer and what type of enterprises he can carry on his particular holding if he has bits of land here, there and everywhere. So trying to reduce fragmentation and a reduction of distance anyway between parcels is something that this was targeted at. There was a very similar relief available around stamp duty, which finished up a couple of years ago now at this stage, 2011, June 2011 I think. That wasn't a success. We got very, very few people availing of it. I think there was around 160 or 150 or 160 people have availed of it. So it wasn't really a runner. And the big problem at that stage was, while there was a bit of relief there for the stamp duty, there was nothing on the capital gains tax side. So when, you know, the swap or the disposal took place, you saved in the stamp duty and still had to pay the capital gains, and the capital gains tax was increasing with subsequent budgets year on year. So we kind of changed tack, or the Department of Agriculture kind of changed tack with prompting from the farm organisations and ourselves to try and look at the capital gains tax side, and this restructuring relief was brought in to allow, you know, the capital gains tax bill on those potential transfers to be reduced. The conditions in question around this relief is that the land obviously has to be agriculture, and it excludes forestry land, peat land and habitable dwellings as well. The transactions have to be carried out by a farmer, and that can catch some people out. That 50% working time rule is one that, that does catch out some people. And the sale and purchase has to take place within 24 months. I think that was 18 months in the old stamp duty one, but you have a 2-year window to carry out your sale and your purchase transactions, and they have to have taken place between the 1st of January 2013 and the 31st of December 2015. And I suppose they'll review it at that stage to see how many transactions took place, and it could be extended. And I suppose the big one then is post-sale and purchase. There has to be a reduction in the distance between the parcels, reducing kind of fragmentation and increasing efficiency. And they're set out, the conditions are set out in the guidelines, and they're at the back of the set of handouts there. Teagasc has a role in this, in issuing a certificate, in looking at the situation and the proposed transactions and deciding to the fit within the guidelines, and we issue a certificate that the transactions comply with the guidelines. But we do need certain documentation for that, and that's kind of where we're back to yourselves. That if you're approached by a farmer that's thinking of this, and he needs a certificate from Teagasc, we need certain documentation in order to be able to issue that certificate. And to save everybody time, we prefer, if the one appointment kind of wiped it out. In other words, we were able to issue a certificate with one appointment. That may not happen in a lot of cases, but we have cases, and we definitely had it in the previous relief, where there was to-ing and fro-ing and looking for this bit and that bit and back and forward to accountants and solicitors and so on. And it would have tied up a lot of your time, would have tied up a lot of our time. We prefer kind of, say, one block a half a day and get it done in the office, done and dusted, and out the gate. So getting the correct documentation, such as the application form, the maps, folio copies of all land, copies of the deeds of transfer, that's what we need, and it's set out in the guideline form there. So and there's a checklist there available. So it'd streamline everything if that was followed. In relation to the restructured relief, the other issues around it, like the stamp duty relief that was there has got the bullet, is no longer available. So there is going to be stamp duty on the transaction, but stamp duty rates, as we know, have been reduced. It was, at the time the original stamp duty relief was there, the rate was sitting at around 6%. It's now back at 2%, and with consanguinity relief there, you're talking 1%. So there's less money involved. So hopefully that'll not be seen as a barrier to these taking place. You're not allowed to sell a complete farm and replace it with another bigger farm somewhere else. That's not restructuring, that's just kind of replacing or scaling up. So we've had a number of inquiries about that you can't just sell everything you have and buy a bigger farm and avail of the restructuring relief. One that has come up lately, and we had to clarify it with revenue, is that disposals under a CPO are not qualifying as a sale, so you won't get CGT relief under capital gains tax restructuring if the sale is as a result of a CPO. And that's kind of a bit of a controversial one, but it's been very clearly kind of stated by revenue that CPO isn't a qualifying sale for this particular scheme. I think they're looking back at some of the legislation in relation to the stamp duty one, because it's not a voluntary disposal, it's not regarded as a sale in this case. And disposals availing of this relief by persons over 55 will count for aggregation purposes for the thresholds that I referred to earlier, say that 750 grand threshold, but it's only by people over 55. Those thresholds only kick in if any disposals are done by people over that age. So just by way of example, of a couple of examples, and I think they mightn't have come out too well in the photocopies there. There could be, I don't know what happened to the photocopier, but this is just an example of one particular case where you have a farmer with his main farm holding here, Farmer Tom, for example, and to give him a name, he has his farmyard or farm hub here in parcel A of 30 hectares, and he owns two out farms, one 5 mile away of 8 hectares, and the other 5.5 mile away of 5 hectares. He decides he's going to flog those two. Parcel B, he's going to sell it to Pat, and another one he's going to sell it to Joe, in the expectation that he's going to buy this parcel of land here, which belongs to Richard. And that's just over the road from him. So he's getting rid of these two out farms and replacing it by purchasing this farm here. Now that obviously is a reduction in distance, and that would qualify for CGT restructuring relief. So he would get restructuring relief on the capital gains tax. And I have a calculation done out for the way the tax would be calculated, and it's also included in the handouts there.
To look at another example, this particular individual here, John has his main farm hub here and farmyard, 50 hectares, and he has a bit of an out farm here, 6 hectares, half a mile away. So he plans on getting rid of this particular parcel and selling it to Michael, and buying parcel C here from Tom, which is a bigger parcel. It's going to increase his overall farm area, but it's a mile and a half away. That doesn't qualify for restructuring relief because the distance is greater. So that's not eligible for CGT restructuring relief. Okay? Because it's quite clear in the guidelines that it has a reduction in distance. Okay? The exemption relief is another relief that's available, and that kind of was brought in 2011, I think, and it allowed gains on land and buildings, and there was a bit of a query of whether land and buildings also kind of qualified agricultural land and buildings. There was thought that it was kind of more dwelling houses that this was aimed at, but it also allows the exemption relief to be picked up on agricultural land. The conditions around that has to be held in the same ownership for at least 7 years, and any incomes or profits or gains must be within the charge to Irish income tax or corporation tax. It allows the relief allows the gain play into that 7-year ownership period to completely relieve from CGT, and if it's owned for greater than 7 years, there's a kind of proportionate relief there. So I know that some farmers were cute enough and saw this and used that as an incentive for them anyway to go out and buy land in the last number of years, and you know, maybe with a view to further down the line transferring it to sons or daughters or whatever, if maybe, or selling it maybe further down the line and getting some of this gain relieved as a result. Capital acquisitions tax is the other kind of main transaction tax that impacts, especially where, you know, in relation to gifts and inheritances, and it's payable whenever they're received for less than full consideration. The rate of tax has been increased over the last number of years. As I had on one of the earlier slides, it's now sitting at 33%. But there's one particular agricultural relief that's targeted at obviously agricultural assets, and there's business assets relief, which are two very valuable reliefs in the work. You know, slightly the same but different. Some of the conditions around agricultural relief, as I say, it reduces the market value of the benefit by 90%, but you have to qualify for this farmer test, which is one that some people would have struggled with. Some people think, you know, this farmer test, is it to do with agricultural qualifications? That comes up regularly. It's not. You can have all the qualifications in farming in the world, you know, and still not pass this test. It's an asset test based on the value of assets after taking the benefit. 80% of the total assets have to be classed as agricultural property. And agricultural property is land, buildings, quota, single payments, quota value of which is declining by the day. Now at this stage, single payment, entitlement, stock and machinery all qualify as agricultural property, even though kind of stock and machinery wouldn't be classed as assets that would be subject to CAT. The main farm dwelling has to be classed, in order for it to be classed as agricultural property, it has to be this famous phrase, it has to be a character appropriate to the farm. You know, if the farmhouse is sitting in the middle of the farmyard, which is in the middle of the land that's being transferred, you would say it's of a character appropriate. It's the main farmhouse. I suppose the problem is, say, houses that are off farm, you know, in the nearest village or a number of miles away, you know, are they of a character appropriate to the farm? And that's taken on a case by case basis. And it's one as it does come up the odd time as to whether that fits in as agricultural property or not. And I'm sure you're well aware of cases where that you've had to get a ruling on that or make a decision on that yourselves. The thing about the farmer test is, you know, there may be a certain amount of planning that has to be required in order to ensure qualification for this. And, you know, our advice is you do everything you can to qualify for this relief in relation to inheritances, because it is so valuable. So if you do need a bit of time and you are planning on making a transfer, you know, it's definitely something you want to be talking to your solicitor or accountant early and getting them to look at your situation. And if there is a bit of tricking around and moving around of assets that has to be done to qualify for this, it definitely should be looked at. The classic one is transferring non-agricultural assets such as dwelling houses into the spouse's name. Maybe that's less of an issue now with the collapse in property prices is maybe being reversed in some parts of the country. But if cash is held as a barrier, and that is an issue that comes up the odd time, it can be invested in agricultural assets in order to qualify, and meet the farmer test. And you can also use bequests that are coming in as part of the estate as an inheritance to invest in agricultural assets prior to the valuation date to satisfy the test as well. A useful one that came in 2007 was that if there was a dwelling house, a non-agricultural property dwelling house held by the person receiving or going to receive the gift or inheritance, and it had an outstanding mortgage, you can use the mortgage to offset the value of the house. Now the revenue were cute enough because they could see there was people taking advantage of that and attaching all sorts of loans to their dwelling houses which weren't necessarily related to the house at all, and they put in a condition that in order for that to qualify, the loan must have been used, the loan that's going to be offset had to have been used to purchase, repair or improve the house. And that kind of cut that off at the knees then, as these other loans that weren't specifically to either buy the house or repair the house. If agricultural relief isn't an option and passing the farmer test isn't going to be able to be achieved, you can qualify for, or it may be possible to qualify for business asset relief or business relief. There's no 80% test for that. So you can kick in and avail of the business relief. There are conditions around that. There's always conditions around all these things. And there's an ownership condition which you have to have the land. The disposer has to have 2 years in respect of an inheritance and 5 years in every other case. If the land is let out, and this is one that catches some people out, if the land's let out, it may not qualify as a business asset. It may be an investment asset rather than a business asset, and it won't be available or won't meet the test for business relief. And you have to continue to carry out the business on the land. This is the person receiving it for 6 years after the receipt. And the farmhouse isn't eligible, which is one that causes disappointment for some people because it's not a business asset, and this whole agricultural property and character appropriate doesn't factor in at all. Moving on quickly to stamp duty, rates came down, big help. They're down at 2% now for non-residential. Consanguinity relief, which reduces those by half, where there's a blood relationship between the people involved in the transaction. There's the clock is ticking on that one, and it's due to be abolished on the 1st of January 2015. So there'll be another full year next year to allow people to transfer residential property and avail of that 50% reduction in stamp duty between kind of related persons. So that's something that farmers need to be aware of. We're making them aware of it definitely, and I'm sure you are as well with your clients. The young trained farmer relief that's available, like that has been available for a good number of years, and they put a deadline on it and they normally roll it over. It's available on transfers up to the 31st of December as it stands at the minute, but hopefully it'll be rolled over again. Farmer has to be aged under 35 at the date of execution of the deed of transfer. Now maybe there might be time to look at that in light of, say, what Andy mentioned this morning in relation to the young farmer schemes, and the top-ups for young farmers where there's an age limit there of 40. Maybe that's something that Revenue and the Department of Finance might look at and push that age limit up to 40 to harmonise the whole thing. You have to have a recognised qualification. It's a level 6 advanced cert in agriculture is what's needed to qualify for that. There's a number of other different certs available, and they're in the conditions associated with it. I think in the budget there was 3 more added in relation to equine and a couple of other courses. The condition there around joint owners is that both must be young trained farmers, except in the case of spouses, where one spouse, if they have the necessary qualifications and can qualify both spouses. Something that came up a couple of times in cases is this potential clawback and the 5-year condition there that you had to have, where the young farmer, when he's availing of the declaration, he signs or availing of the relief, he signs a declaration basically to say that he's going to continue to farm the land for 5 years, and he's going to spend 50% of his working time doing farming the land. How does that impact for farmers maybe that are thinking of leasing land into a company or doing short-term leases? And we got a bit of clarification on some of those cases. I mean, the ownership one is fairly clear. There'll be a clawback imposed if there's a disposal of the land and it's not replaced within 1 year. So if it's straightforward, the land is disposed of, not replaced, clawback. Okay, so it's fairly clear. But a short-term lease of the land, you're still retaining ownership. Okay, you're leasing it to somebody else, so there's no clawback there. But the lease then brings into question then, well, what about this 50% of normal working time farming the land? And this is where it kind of gets a wee bit grey. The test here is, this is me kind of paraphrasing, it is at the time the declaration is signed, was it the intention to continue to spend 50% of the working time farming the land? This came up in a case particularly with a company where the young farmer took the land, availed of the relief, signed the declaration. I think 2 years after that he decided to set up his company and lease the land into the company, but he was worried that that wouldn't qualify him, or he'd end up with a clawback because he wasn't fulfilling the 50% time. But the argument was that at the time he signed the declaration, he intended himself as an individual to spend 50% of his time. He now set up his company, and there's according to revenue anyway, there's no problem there. There's actually no clawback provision around this 50% working time. There is a penalty through an untrue declaration, basically, is what applies there. So there's no actual no provision in the legislation to claw back the relief, but you could be hit with a penalty. But as I say, you're down to this test here. At the time the declaration was signed, was there evidence that the young farmer intended to comply and could comply? In relation to single payment scheme transfers, very, very tricky area. You definitely want to involve your advisor in this, or consultant in this, when you're talking about this, because there's all sorts of implications. The Department of Agriculture, Food and Marine have a very, very good unit available, the Inheritance Inquiry Unit, and that's the address and the phone number. Excellent people in there. If you have a case where there's a single payment issue or entitlement issue where it's going to be transferred, well worth getting in touch with those people early in the process just to clarify things. And they also act as a conduit for all the paperwork in relation to transfers and inheritance. They kind of organise the whole lot and make sure it goes in the right direction within the department. The thing about entitlements that people always get confused of is they don't automatically follow the land. The land is used to draw them down. Land was used to establish them initially, but they're within the ownership of the farmer, and they attach to the herd number of the farmer as such. So in a lot of cases, and it happens time and time again, is that somebody dies, they have a will made, the land is to go to party A, and the residues to go to party B. And in the will, it just mentions the land, it doesn't mention the entitlements. And in that case, the entitlements end up in the residue and then go in completely different directions. And you end up with a dog's home getting, entitlements, or the nuns 50 miles away getting entitlements, and the farmer sitting there with the land and, no entitlements on it. And it gets extremely messy. Now, it can be organised all right with both parties if they agree, but you have heard cases where it can get nasty enough. So retirement relief is available if entitlements are disposed of with the land. And there was a few people kind of rang me about this over the years because of this 10-year ownership and use rule. Because entitlements, Andy or maybe Fintan mentioned it this morning, these single payment entitlements only came into being in 2005. So they haven't been around for 10 years. So how can you have owned, if they're an asset that's being transferred, how could you have owned and used them for the previous 10 years? Now, it was understood, or I always understood it, that the land kind of qualified the entitlements. I was always of the belief that provided the land and the entitlements were transferred together, the whole lot qualified. I got clarification in that sense, and from reading the legislation myself, qualifying assets are listed, and this 10-year ownership and use rule is mentioned in every line in relation to other qualifying assets. But when it comes to the entitlements, it doesn't mention anything about the 10-year use and rule. The only thing it mentions is that they have to go with the land in order to avail of relief. So that for me is a good enough reason to say that retirement relief applies. There's no stamp duty on transfers of single farm payment entitlements. No VAT on transfers of entitlements by inheritance or gift. It catches some people out where they're sold without land and the sale proceeds cross 37,500 with a total of all sales of entitlements within a 12-month period. Then VAT has to be charged at 23%. And whatever they're sold for, that's the VAT inclusive price. So you end up with somebody, and it has happened where people have been caught out where they've sold land for 50 grand, or sold entitlement, for 50 grand, and that's the VAT inclusive price, and they end up having to hand over 23% of that to revenue, and they end up with a hell of a lot less for their entitlements than they thought they were getting. The disposing farmer can register for that single transaction. They don't have to become VAT registered for everything. There's no VAT if the entitlements are sold with land to another farmer. Very quickly on income and corporation tax for farm businesses. In relation to the capital allowances, these are going to become obviously, more important as more investment is done on farms. There was a bit of talk about some of these in the Commission and Taxation report, particularly this farm buildings one, which is, over 7 years, 6 15s and a 10. There was talk of bringing that all in at 5% for commercial buildings, the same as it is for other sections. Investments in quota, there's capital allowances available there under section 669B and of spread over 7 years. We're coming to the end of quota, thanks be to God for some people, are dying to see the back of them, that they can plough on. If there's quota bought over the last number of years and there's unused allowances, you can actually claim those balances allowances after quotas disappear. In relation to stock relief, it was mentioned by Ben, I think there's 100% relief available for young trained farmers. That 35-year limit applies, and you can claim the relief for up to 4 years. There's a requirement now, and this is new. I think it was always there as a requirement, but it was never kind of enshrined in the legislation. But it is now that there's a requirement to submit a business plan to Teagasc as to avail of this stock relief. And that business plan, it can be if the young trained farmer has been through Agricultural College and done his green cert, he will have done a business plan as part of that. And that can be kind of reheated, let him dig it out from wherever he has it, through it in the corner after finishing his cert, and dust it down and rejig it a bit. It can be used to avail of this. There may be cases where a new business plan might have to be prepared. It has to be submitted for Teagasc for verification to say that it's a genuine plan, and then there should be no problem with the relief. There is an upper limit as well on the stock relief, which was introduced, 40k in 1 year with an overall max of 70k over a max of 4 years. In relation to the farm partnerships, I'm not going to cover this because Ben already mentioned it, in relation to young trained farmers and non-young trained farmers, there's 50% relief instead of the normal 25. There is this kind of max also there, the 7.5 over a 3-year rolling period of the relief, but that's a monetary max. It's not an actual difference between the stock values max, and it's quite complicated the way it's calculated, but it is a limit that was imposed in there. The partnership has to be registered with the Department of Agriculture and Food, and we're the registration body at the moment for that, for milk partnerships. But the department will look for that. In relation to the land leased income exemption, and Ben picked up on that this morning as a collaboration method, there's good reliefs there available depending on the term of the lease, and there's different limits. The exemption is from income tax, but universal social charge, the course that it is, and PRSA still apply to the lease income, although the income itself is exempt. It has to be a qualifying lease, it has to be in writing, it has to be arm's length, and it has to be stamped, which is something I suppose that maybe we were remiss in. We weren't kind of telling people explicitly, geez, you need to get this lease stamped in order to qualify for it. But it has to be, our understanding now is that it has to be stamped officially by revenue in order to qualify for the relief, or to be sure of qualifying for the relief. The single payment entitlements also come in there, provided they're leased with the land. And I don't know whether that's going to change in light of what Andy said this morning or earlier on about, in future arrangement where entitlements can be leased separate from the land. They probably won't qualify in that case. They will qualify in this case if they're leased with the land. Connected parties are not eligible leasees. So a big one that a few people have got very annoyed about is a farmer and his company are not eligible. So a farmer can't lease land to his company and avail of this relief. Uncle to nephew and cousin to cousins are okay. And interaction with retirement relief, as I said earlier, the 15-year rule and allowing people to dispose of land if they've leased this out kind of helps that exemption and helps people avail of it. Setting up a farming company, a lot of inquiries about this, or we're getting a lot, and I presume you're getting a lot as well. It's kind of flavour of the month at the moment, and again, I was talking to somebody over lunch there, and they were saying, and we found it as well, there's different views on this out there. We're kind of keeping a very neutral view on it. We're kind of saying, you need to look at all angles, you need to assess it on your own individual basis. Don't be following the herd and doing what everybody else is doing. But some accountants kind of have the view that it's the greatest thing ever, and other accountants are kind of here and saying, stay well away from that. You're happy enough as you are. The different reasons that people, obviously the first one is, I'm paying too much tax, but I'd say regardless of what you did for some of your clients that still say that, even if they were paying zero tax, they'd still come up with some kind of way that was even too much. The other one is investing in the farm. I have to invest. I'm going to be taking out big loans, and I need to have the cash flow in order to meet the repayments. And paying a whack of money in tax at 55%. I'm not going to have that available, so the company could be the route there. Some people have a view to, maybe farming for another number of years and handing over, and they want to be able to take a step back from farming entirely and, have a decent pension pot there, and the pension provisions within companies allows people to whack money away into a pension with less limitations than for people on a sole trader situation, and they can build up a pension pot over a period of time while they're in the company, and then step back from the company, hand over to the next generation, and live off the pension, or nearly live off the pension, depending on how much they have away. And the last one is one that it seems to be we come up time and time again with groups. Some people think they're not farmers at all unless they're in companies now at this stage. You're only a Mickey Mouse operator unless you're in, a company and have PLC after your name, or limited liability after your name. So, following the herd is never a good idea, and I think our advice is you need to get in and talk to our accountant early, and your solicitor if needs be, and if you do need to get a second opinion on it, from an accountant or professional or a tax advisor, by all means do. That's what we'd be advising anyway. The kind of questions are around, and I'm not going to dwell on this in terms of because the issues around companies is how much of the profit do you need? Is there outstanding capital allowances? Do you intend to carry out investment? Do you intend to transfer within the next number of years? The options for the land is something that a lot of people can agonise over. What do I do with the land? I want to hold on to the land myself. Do I transfer it into the company? There's capital gains tax implications unless you lease the land into the company. And Andy touched on it this morning in relation to land being leased in and entitlements being leased in and the implications there. And we're still not 100% clear on how that's going to pan out under the new arrangement, but we'd hope that it wouldn't be disadvantaging people that did go into companies. If the entitlements are sold into the company, there'll be CGT and stamp duty issues. I know of a couple of cases where this has been done, particularly where there's large personal debt sitting in the hands of the farmer. He bought a villa out in such and such a place and the fucking value of it has collapsed and he has a huge loan, and he's under pressure with all the personal tax that he has to pay on his farming debt to meet it. He sets up a company and the company borrows the money to pay the farmer for the land. He transfers the land to the company, pays the CGT, gets the bank on board to lend money to the company to pay him for the land. He then takes that money and pays off his personal debt. There's also the director's loan one as well, which is an option to allow people to take money out over a period. There's issues around succession in terms of retirement relief, whether the land is leased into the company, and if the shares in the land are transferred to the same person. So you need to be careful around that area, and that's something that definitely a professional advisor needs to look at if a transfer is on the near horizon for the farmer. And there's also on the other side agricultural relief issues, because shares in a farming company don't qualify as agricultural property. Business relief, asset relief may be available on those. So few people that need to be informed. Regularly happens around single payment application time is, we don't hear about a company being set up until the last minute, and with the single payment application put in the farmer's own name, and then as he's going out the door he says, I'm actually in a company, and you end up having to scrap the whole lot and start again, and transfers and everything else. So you need to, the farmer needs to start informing people. If he's discussed it with his accountant, he needs to get on to his advisor. He needs to get on, obviously, to his milk processors and so on. If he's a dairy supplier, suppliers and insurance companies and so on, particularly around the entitlements, you need to get on to advisors and consultants early in the process. Second last slide then. Dairy sector is kind of the in vogue sector at the moment, with milk quota abolition taking place April of next year, or April 2015. There's a trend, and a rising trend the last number of years in dairy profits, which has put some farmers haywire in terms of the tax bill that they're going to be having to pay. I was speaking at the dairy conference a couple of weeks ago, and I got 2 or 3 different questions from the floor in both venues about rising tax bills. It is something that's an issue for them, and that's what's driving people maybe to look at companies. But there's going to be huge volatility in milk prices, so we've had this year particular very high milk prices. There will come years when we'll be back very close to 2009 type prices, so that people need to be aware of that. But managing tax bills and meeting increasing labour and debt for somebody that's expanding is going to be a challenge in some farms, and we'll need your expertise and guidance as accountants, and we'll need our own Teagasc expertise to help people get through that. The future investment on dairy farms, a lot of it is going to be kind of trying to build up a land base to be able to milk all these extra cows that people want to bull on and milk a lot of extra numbers. And that's going to be milking platform land that can be easily grazed by cows. It can be slurry storage and housing capacity. And you know, the type of debt repayments that are going to have to be taken on, and Jim Power referred to it this morning, that he was cautioning young farmers about taking on a lot of debt. You know, managing that debt in periods of low milk price is going to be an issue for some farmers, no doubt about it. And they need to be aware about what they're getting into. And we're definitely trying to, you know, while we're encouraging them and you know, helping them and assisting them as best we can, you know, a lot of the business plans we're doing, we're basing it around a milk price of around 30 to 31 cents a litre, as opposed to, you know, some of the crazy 41 plus cents a litre you do see on some milk plan or business plans. The focus on investment is going to be less so on dry stock and tillage farms. It's dairy farms that are going to be the main drivers of a lot of the investment and spending over the next number of years.